Here is why some people prefer investing in treasury bills as compared to MMFs. Since January this year, the rates of both MMFs and treasury bills have been falling consistently since the Central Bank of Kenya has been lowering the base lending rate from 10% to the now 9.5%. T-bills are short-term securities issued by the government to raise money from investors. So when you buy bills, you're basically lending money to the government for, let's say, 91, 182, and 364 days in return for a guaranteed fixed interest at maturity. On the other hand, MMFs are pooled investment accounts run by fund managers who collect money from different investors and place it in low-risk assets such as government securities, bank deposits, and commercial papers. While MMFs offer compounding interest rates and part of their investment go to T-bills, some investors prefer putting their money in T-bills whose returns are fixed. So in this video, we analyze why some people prefer putting their money in T-bills as compared to MMFs. Number one is that the returns are fixed. So with T-bills, you know exactly how much you will earn by the time your money matures. So for example, going with the most recent 364-day T-bill, which had an interest rate of 9.5%, investors who invest in these bills will get a fixed return. And that means that the interest rate does not change. Interest rates of T-bills might also fluctuate depending on different things such as government policies. And this in turn will affect MMFs because MMFs obviously invest in T-bills. On the other hand, interest rates of MMFs keep fluctuating, and when the investor is making an investment, they are not certain of a specific guaranteed interest rate. So in this case, T-bills are more predictable as compared to MMFs. For instance, let's take an example of investing 100,000 in a 364-day T-bill that offers an interest rate of 9.5%. So at the end of the year, you'll have a guaranteed return of 9,500, and that is before tax. On the other hand, with MMFs, the returns are not guaranteed. Secondly, is that you have less access to your money. So with money market funds, you can easily access your cash because it is liquid. But for people who prefer to lock their investments so that they are not tempted to spend, T-bills are a better option. So once you invest, you cannot touch that money until it matures. Thirdly, there's no management fees. When you invest in T-bills, the returns you're promised are exactly what you get minus the 15% withholding tax. With MMFs, the same 15% withholding tax also applies, but on top of that, MMFs have management fees that are from 1% to 2%, which are charged by the fund manager. This fee is deducted before the net return is accredited to your account. So over time, the management fees, in as much as it looks small, can cause much difference. Next are the risk levels. So T-bills are considered to be one of the safest investments simply because they are government backed. So as long as the government does not default, you are guaranteed your money as well as your interest at maturity. This is as compared to MMFs that are handled by fund managers, and the decisions that fund managers make influence the risk levels that come with the investment. A well-managed fund can give you higher returns, but a poorly managed fund can lead you to losses. So while the risk is still low as compared to other investments such as stocks, it's not as certain as government-backed T-bills. Let's look at some of the disadvantages of T-bills. Number one is locked access to your money. So once you put your money in a T-bill, depending on the tenor that you put, maybe it's 91 days, 182 days, or 364 days, you'll get your money at the end of that tenor. In this case, it is advisable not to use T-bills as your go-to for your emergency fund. You can use other investment options that can allow liquidity for your money. Secondly, there are fixed investment blocks. So when you're investing in T-bills, you invest in fixed amounts. Let's say, for example, the minimum amount is 50,000 Kenya shillings. So after 50,000, next you can invest in 100,000 and then 150, 200, and so on and so forth. This makes them less accessible if you want to start with smaller amounts. Lastly is auction complexity. Unlike MMS where you simply deposit money and start earning, investing in T-bills requires going through the central bank auction system, do your research, and also understand auction deadlines. For beginners, this process can feel confusing, unlike other investment options. Depending on your financial goals, both T-bills and MMFs can work for you. If you want guaranteed returns, T-bills are safer. If you want flexibility and quicker access to your cash, MMFs are the go-to option. The key is to do your research and choose what aligns with you. For these and more investment tips, we have a partnership with Lua, which is a free AI assistant on WhatsApp that can help you schedule your meetings, budget your money, plan your meals, as well as give you the different investment options that you can venture into before investing. Click on the link on our bio to try out Lua today.